Imagine a person standing at a hospital billing counter. Their family member has just come out of surgery, and the nurse says, "You can claim this under insurance." So they hand over their cashless card, the one that they've been paying premiums for every single year. But instead of a swipe, they get a shrug. Cashless is suspended, so you will have to pay now and claim later. In that moment, the promise of insurance, the one thing meant to protect them in a crisis, feels like it has suddenly vanished. Now, imagine that same scene playing out for millions of people across India. Because it is. Over the last couple of months, some of the biggest private hospitals, Max, Manipal, Medanta, and the country's largest insurers, Star Health, Niva Bupa, Tata AIG, have been quietly cutting each other off. Cashless services have been suspended, and policyholders are caught mid treatment. Each side is blaming the other. Hospitals say that insurers have not updated rates for years, even though medical inflation is hitting 13%. And insurers are saying that hospitals are overbilling and refusing to standardize. And while the two sides trade these accusations, 550 million Indians, which is basically every third person with a health insurance, are left wondering who is really looking out for them. But behind the polite press releases and technical terms lies a much deeper question, one that might redefine healthcare in India altogether. What happens when the system built to make treatment affordable can no longer afford itself? Welcome to Daybreak, a business podcast from the Ken. I'm your host Nigda Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that is worth understanding and worth your time. Let's rewind to how this all started. In September, Star Health, which is India's biggest standalone health insurer, pulled cashless services from several major hospitals in North India. And their complaint was big hospitals were demanding rate hikes that exceeded inflation. A Star Health executive pointed to hospitals like Max wanting major revisions, which were far higher than the 13% rise in medical inflation. Meanwhile, the insurer was pressuring smaller hospitals to reduce their rates. And that was the last straw. Girdhar Gyani, who is the Director General of the Association of Healthcare Providers of India, or AHPI, called it unacceptable. He said tariffs are supposed to increase with inflation, not decrease. So AHPI demanded Star restore cashless services immediately. And this was not an isolated flare-up. In August and September, Niva Bupa and Tata AIG suspended cashless treatment at Max hospitals, which is a network of 22 centers across North India. And earlier in February, Care Health halted services at 12 Max hospitals in Delhi NCR. So, as expected, hospitals retaliated too. 15,000 of them under AHPI suspended cashless access for Bajaj Alliance policyholders. Each side was basically flexing their power. Each suspension meant policyholders were paying out of pocket, defeating the very purpose of insurance. Eventually, AHPI reached temporary compromises with Star, Bajaj, and Care. But these were bandages, not cures. So, in October, both sides were expected to meet again. And the goal? A white paper, a guiding document to bring structure into this chaotic relationship. But this deadlock did not appear overnight. For smaller hospitals, it's been a slow bleed. Many have been working with outdated insurance rates for years, some unchanged since 2011. Meanwhile, surgery costs have tripled since 2016. Cataract, appendectomy, cancer are all up by around 300%. Larger hospital chains like Max and Medanta have more leverage, but even they are being paid 2021 to 2022 rates. As one Max executive told the Ken, our net profit is around 10%, and most of that goes back into robotics and expansion. We are just keeping up with inflation. So, hospitals argue that they are fighting for survival, and insurers insist that they are fighting against excess. And that is where the battle lines are drawn. But here's the thing, on the insurer's side, things don't look very rosy either. More on this in the next segment. You see, expenses for insurers are rising faster than the premiums that they collect. In the financial year 2025, for example, the combined ratio, which is the total expenses versus total premiums, hit 102%, which was up from 94% the year before. Anything above 100 means that they are losing money. Basically, hospitalization costs are up, health insurance payouts are up about 30% over the last 3 years, and commissions, which is the chunk paid to agents, can be as high as 45% of the premiums. Even after renewal, they hover around 10 to 20% plus special bonuses. So, insurers are trapped. Hospitals demand 20 to 25% hikes, intermediaries take their shares, and margins basically vanish. To recover, insurers have started reducing claim payouts or cutting part of hospital bills that they call inflated. Hospitals naturally accuse them of unfair deductions. Insurers hit back. You are charging 120 rupees for a pair of gloves when a whole box costs 80 rupees only. Hospitals respond, every person who touches a patient needs new gloves, and that is the cost of infection control. So, you see, it is endless and it is circular. In September, the National Medical Commission stepped in with 157 standard treatment workflows across 28 specialties, hoping to create uniformity. Hospitals called it a good start, but impractical. One size does not fit all, said one executive. You can't run a hospital like a factory line. There are no national categories for hospitals, no government standards that differentiate based on size, infrastructure, or technology. The National Accreditation Board for Hospitals now says that it is developing a ranking system to fix this, something that it calls a pressure relief map. So, in the October meeting, the General Insurance Council was planning to present a common empanelment kit, meaning if a hospital is approved by one insurer, it is automatically recognized by all. That could end the endless back and forth on rates. But before any of that, insurers need to fix their own math. Only 55 to 65% of premium income in India actually goes into the risk pool, which is the shared fund used to pay claims. Globally, that figure is closer to 87%. And with the new GST rules preventing insurers from claiming tax credits on commissions, they have started cutting agent payouts by 18%. Obviously, agents are not happy, and they are already pivoting to other insurance products. So, as hospitals push for higher tariffs and insurers try to keep losses in checks, the tension keeps rising. Today's temporary compromise could be tomorrow's new suspension. Because this is not just about a business dispute, it is a system tearing at its seams. And for the 550 million Indians caught in the middle, the real question remains. When the next medical emergency hits, will your insurance card still work?
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings, and a full subscription offers daily, long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.